afternoon, everyone, and Happy New Year. Welcome, everyone, to our fourth Software Business Quarterly Review and Cast, delving into the recent results of TBR Software Vendor Reports and the Software Business Benchmark Report. My name is Analyst Crawford, and I will be your host for today's session. Last year, we have engaged with our readers through our quarterly webinars to provide you with additional insight into the state of the software market. Good questions and discussions, and we're excited to continue to connect with you as the TBR software practice grows. Before I pass this over to Stuart and Elizabeth, there are a few quick housekeeping items I'd like to cover. First, we'll be recording today's session and posting it on the YouTube site, TBRI channel. We invite you to visit this channel to watch this presentation or any of the others that we've posted. We'd like to hear your opinions and thoughts on the materials we're presenting. Please questions or comments to the Q&A or chat function. Stuart and Elizabeth will address them at the end of the presentation. Or if you'd like to set up a client inquiry for more detailed discussion, please reach directly to Stuart or Elizabeth at the end of the webinar to set up that discussion. Third, we'll send out the slides to everyone registered for today's webcast within 20 hours of the conclusion of the webinar. You can also find the slides, as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.share.net/TBR_market_insight. Let me introduce Stuart Williams and Elizabeth Hedstrom Henlin. Elizabeth is our lead analyst covering enterprise software and has been working closely with the vendors covered in this report to understand their business models and strategies. She leads our software and cloud research team and has been influential in developing Source IT, a cutting-edge research program focusing on buyer behavior in verticals like retail, manufacturing, healthcare, energy and utilities, among others. And with that, let me hand this over to Stuart.
Listen, Happy New Year to everybody joining us today. Thank you for taking the time out to get our update on TBR's software coverage, looking at the 3Q12 business of the enterprise software space and some of our outlook going forward for the rest of the year and into 2013. Today is going to be based around a synthesis of the vendor-centric reports that we deliver, the software vendor reports in this slide, as well as we're pulling data from our expanded software vendor coverage, which is in our software vendor benchmark. Additional webinar coming up in a week around our cloud practice, which will synthesize information from our cloud vendor reports and our public cloud market landscape. So hope folks on this call are also interested in cloud and a business view of cloud computing, and are welcome to join us on that call as well. So let's move to the next slide here. So for those who are joining us for the first time today, Technology Business Research takes a business-centric lens in doing an analysis of the vendors that we cover and the segments. So for the software business quarterly, look to and all of the firms that we write reports on through these multiple lenses of strategy, go-to-market, financial perspective, resource management, the aligned acquisitions point of view, as well as developing our point of view around the forecast and future outlook for these firms. We take a lot of data that is public information, publicly reported. We work with firms on covering them through multiple briefings, going to on-site. We do a significant amount of end customer research that gets integrated into our analysis, as well as conversations with channel partners, resellers, and alliance partners to just build out a full picture for each one of the firms. I'd like to ask Elizabeth to join me as we proceed through the rest of the presentation today.
Thanks, Stuart. As we look back at the calendar year third quarter 2012 vendor landscape, I think the big takeaway for us is that the story continues from our second quarter coverage. With the continuing uncertainty in the macroeconomic environment, we watched not only in our end-user research but in our vendor-centric conversations, the customer buying cycle will continue to extend. It was those vendors that had the agility and, in many cases, the wallet to invest ahead of their own performance that were the real leading case studies for the quarter, trying to long-standing strategic patterns in order to outperform lagging markets. three areas of concentration that we're going to cover in today's conversation focus around product, sales, and corporate business models, specifically portfolio extensions, how vendors looked at their core offerings and attached trends like cloud and mobility to rapidly refresh and monetize core business lines. Investments, how vendors were able to take not only their direct teams but their channel teams and incent performance that countered ongoing market trends, and corporate efficiency, where vendors were focused on how to change the way they did business internally to maximize margin, increase profitability, and accelerate the monetization of investments across the portfolio. So with portfolio extensions, we looked at the third quarter 2012 calendar quarter. Again, I want to emphasize that we're talking, when you see 3Q12 throughout today's conversation, this is calendar quarter, 3Q12. We looked at annual revenue growth within the 33 vendors covered in our software vendor benchmark, and we saw a drastic drop year to year, from 17.3% growth in third quarter 2011 to 4% growth in third quarter 2012. Demonstrating, and we'll look at a regional view of that performance later on in this conversation, the continuing extension of customers' buying cycles and customers' focus on niche additions to their environment rather than wholesale reinvestments. The customers we talk to are really looking to put off big spends until at least the middle of this calendar year. Or to the graph in front of you, this is from our third quarter 2012 software vendor benchmark. The horizontal axis looks at license revenue growth year to year. The vertical axis looks at total corporate revenue growth year to year. So I want to emphasize that for a number of the vendors in this segment, like Oracle, like Salesforce, that does include the full extent of their business. And when not just at this quarter, but across 2012 to date, the license growth rate we're seeing is single digits. But those vendors that were at the leading edge, including VMware, Red Hat, and Oracle and SAP, edging to just miss outperforming the average, focused on product-led messages to attract and incent increased spending within their install base. Now, this is the view from a year ago. This is from our third quarter 2011 benchmark. And as you can see, the leaders and laggards are a lot more evenly split between the quadrants to date. You've not just a broad variety of vendors. There are cloud-led and virtualization-led in the leaders quadrant. A number of vendors with very different application-led strengths that took the leading edge of performance. The solutions vendors really focused on pushing the envelope for their own ability to deliver end-to-end purchasing, and our end-user research, particularly around private and hybrid cloud, shows that customers are seeking simplicity not only in their deployment but in their purchasing path, and that really drove increased performance for a number of the larger traditional enterprise software vendors, or at least allowed them to buck the trend of leading edge.
Thanks. We're going to jump in at this point and give us a little bit of context for how the performance aggregate of the companies in our benchmark has changed over time. So on this slide, we're presenting a 12-quarter retrospective looking at aggregate revenue for all the companies that we cover in our software benchmark, as well as the average revenue growth across the firms and the average operating margin across all of the firms. So when we look at aggregated revenue, we see it ramping up, coming out of 2009, stabilizing at the end of 2011, beginning to drop off in absolute terms across 2012, but the growth rates certainly are falling off, and that's the green line here. The operating margin, we'll have some more conversation about that later on here. We see operating margin performance dipping below numbers that were reported in 2011, really comparable to the environment we saw early on in 2010 right now. So for the industry to experience a turnaround carried by 4Q numbers, the numbers there would have to really be astounding to turn this year around. What we're looking at is a bottoming out across the first half of 2013 before we begin to see some renewed growth, and that's given some pretty rapid stabilization of the global markets in EMEA and Asia Pacific to help drive global revenue for the industry vendors that we're covering here. But obviously, you look at the trend lines, overall over the last time from 429 to now is trailed up, but last year the trend has really been down.
As you'll see as we move through our conversation today, that can largely be credited to expand headcount and acquisitions as vendors are seizing near-term opportunities to jumpstart performance on a market and segment-by-segment basis. Our benchmark perspective, for those of you that are new to the call today, we like to shift to what we call studies around those vendors that we cover within the software business quarterly portfolio. These are our quarterly reports, in some cases semi-annual, that look at vendors' business performance end-to-end and bottoms up. Then the look at portfolio extensions, we will highlight Microsoft, Red Hat, SAP, and VMware from our report portfolio point of view. And in the end, what all of these vendors have in common is a focus on target additions to either flagship products or end-to-end portfolio perspectives that unify, that you can refresh a core business model. In the case of Red Hat, moving beyond the legacy middleware and operating systems point of view to embrace cloud management and storage. And SAP using mobility as a means to tie diversifying application-led and cloud portfolio together into full-fledged business solutions. For Microsoft and VMware, I think to many folks on the call, it's a similar story to one another in that they have a flagship product that has suffered some areas of weakened perception and weakened adoption in recent quarters. And they're looking at tying high-interest features in the case of Microsoft around Windows 8 and high-interest initiatives such as industry-led perspectives in the case of VMware and their vSphere product, keep these core front and center in the corporate, in the go-to-market, and in revenue growth. In VMware's case, for example, the core station portfolio remains better than 90% of total revenue. So its stakes are high for both Microsoft and VMware to sustain and maintain the growth of these products across the coming year.
And I hope to jump in a little bit and provide a little context to the pro picture for each one of the vendors. When we talk about Microsoft, VMware, the Windows 8 adoption rate is initially low, and it's going to grow over time. But the opportunity for Microsoft remains in the perception space to closely tie Windows 8 to the portability of the cross-platform operating system, and that's tied to applications and the data mobility for people to adopt the Microsoft platform for PCs and tablets and mobile phones as opposed to other platforms. So it's an evolved marketplace that has more devices attached to it. We believe that the Windows 8 platform offers a solution, an incremental solution to that gap. And that the marketplace is beginning to grow into that acceptance. VMware continues to move up the stack. The challenge there is that there are vendors that are moving down the stack in the systems management space, running against VMware or running towards it. Again, tying in significant open source offerings to help manage the stack. We see OpenStack as a leading open source offering for people to begin to develop and deploy cloud on, and that again begins to capitate some of VMware's potential market in this space. So I just throw those two out for those two key vendors in the space before we move on. Elizabeth?
Thank you, Stuart. So from product and portfolio, the natural progression to go-to-market. How are vendors taking these expanded portfolios to customers, both directly and indirectly, and most importantly, without cannibalizing each other's opportunities? I looked around, as we looked around vendors in our landscape across calendar year 2012, what we saw was a targeted initiative across the landscape, regardless of vendor, regardless of size. I wanted in terms of targeted functionality and product-led, as well as real go-to-market partnerships designed to drive sales at a very focused, particular level. I think one of the more interesting, to me, initiatives within my report coverage includes the pending launch of the Bill Initiative, which brings a number of assets from VMware and some of their more diverse assets that had some difficulty monetizing in the past 6 months, back into the control of the majority shareholder EMC. So to be clear, this includes the vFabric product, which is primarily by the legacy SpringSource acquisition of 3 years ago, as well as their purchase of Set, which is a big data analytics firm. And it consolidates those products along with a number of end-user-focused and applications-focused products, including Pivotal Labs, as a part of EMC, or Palmer. And I think this is a good example of a different way of looking at consolidating assets as a means to expedite go-to-market success. With Palmer moving to a strategic role inside of EMC focused on applications, it is, in my opinion, a very set move on the part of both firms to consolidate those assets that Moritz brought in-house while he was at the lead VMware into a role where he can be agile in doing not only development but sales growth. So moving to the landscape. Now, following 3 slides, take a look at how the vendors within our software vendor benchmark went to market successfully by, or in some cases not successfully, by region across the quarter. The first graph we're looking at is the Americas. Again, vertical axis remains corporate revenue growth. The horizontal axis is aggregate Americas revenue growth. By far, the Americas remains an incredibly mature market, particularly relative to the rate growth in APAC. And notice that it's those vendors that were able to galvanize some subscription-led initiatives, sales, rapid sales, particularly targeted around first trends like BI and analytics, cloud, mobile, and even in some areas, storage and storage management, able to drive leading-edge growth in the quarter. I think companies to watch for in the last quadrant include Dell's software division. Really, we expect them to move pretty seismically across this calendar year. I believe that the vendor remains in progress of reconciling a lot of the legacy Quest assets, as well as consolidating their go-to-market strategy and alliances. Like EMC, like Oracle, has a particularly cooperative situation with its alliances as they move to consolidate an end-to-end stack perspective. We expect them to be seismic movers across this calendar year. One company that we're keeping an eye on remains Symantec. Their new CEO in place, Steve Bennett, and we'll talk about them a little bit later on in the presentation. This man who has proven turnaround success and who is moving end throughout the business in real time, assessing not only portfolio, but sales, strategy, and partnerships to figure out what is going to be finally that lever to pull to rocket Symantec back into the leading column. And from a Go perspective, you'll see that, the Americas do not remain immune to the broader market uncertainty and the extended customer purchasing cycles, as the world was a lot closer to the average in the leading edge a year ago to date. You notice that America's revenue growth was in the single digits in this quarter, but it was 11% a year ago. So double digit to single digit remains a consistent trend across the board, region by region. It's interesting to see that a number of vendors that we track are starting to split the E out of EMEA and looking at the Middle East and Africa as their own high-growth region and putting distinct and separate assets on Europe and its particular geographic and security-led, in the case of cloud deployment, concerns. The region declined year to year, 1.7%, though considering the ongoing significant uncertainty within the countries of Portugal, Ireland, Spain, to name a few, the fact that performance remained relatively flat, in my opinion, shows the ongoing install-based strength of leading-edge vendors in that region, including SAP. So something I've also neglected to note until now, the size of the bubble within the graph represents the relative size of the business compared to other vendors within our benchmark. So you'll see that the revenue stalwarts remain Oracle, SAP, Microsoft, and IBM software within Europe. Again, a year ago, you're looking at 24.7% average year-to-year growth within the region, fueled significantly by cloud-led vendors. The average is far further along, so I think the perspective of laggards in this graph is relatively skewed year to year. Asia and Asia-Pac remain a particularly interesting question, particularly within the vendors that I focus on, which include VMware and Oracle. This is a region where 2 years ago you had customers questioning whether or not virtualization was a real trend, and now you see added adoption of virtualization and cloud computing as high-interest trends in real time. So APAC was really the region that bucked the trend, showing 11.8% year-to-year growth and demonstrating the extent of the opportunity remains within the region. I think the level of corporate investment in not only facilities and infrastructure, but sales and support personnel in country, particularly in China, shows the importance that this region is going to continue to play in galvanizing corporate growth rates, particularly within the juggernauts of Oracle, SAP, IBM, and Microsoft. I always think of those companies, it really is like turning a battleship, and they have the ability to invest at materially significant levels, but that's what it takes to really drive change, particularly in the short term. A year ago, over 24, nearly 25% revenue growth in the region, but as you see, the diversity of the vendors in the leading area remains far more diverse than it was in this quarter. Forgive me. The leading edge adopters were those that anticipated the need to invest in region. VMware in particular was at the leading edge of driving physical presences in high-growth countries within the region to expedite sales and, most importantly, support and R&D within these regions. And that's going to be a particular driver of consumption in our end-user research, particularly in India and China. Customers in these countries are looking for vendors to show that understand and are aware of the particular needs of these customers and user bases, and there's nothing like a physical presence to show that you get it.
Thanks, Elizabeth. So taking a step back, we wanted to take another retrospective look across our aggregate benchmark to understand how all the headcount additions average out and what the impact might be for productivity over several quarters. So when we add out the number of total employees for the different software firms that we track, grown significantly from over 15,000 to just over 17,000 over the last 2 years. And one of that we also want to understand is, how's the productivity per employee changing over that time? So in response to economic recovery, we see it spiking between 4Q10 and 4Q11, but since then it's really begun to drop down, and we attribute that in part to firms making acquisitions and investment in headcount to sustain and capture growth, especially in growth markets. We've seen some rationalization of headcounts in core markets, but largely we see a fairly consistent, despite the slight variation in the revenue per employee, it's pretty consistent, right? So vendors are managing that revenue per headcount pretty tightly. There's weakness in some regions. Vendors don't necessarily want to drastically reduce headcount because they want to keep the boots on the ground so that they can capture opportunity when it returns. So tracking this, and we continue to track this every quarter. If anybody on the call has additional questions about specific vendors or how we can create a view like this for you, just be happy to support some folks. Just let me know.
Again, to our go-to-market case studies, and within our software business quarterly report portfolio, BC Software, CA Technologies, and HP Software, all companies in a distinct degree of transit and in some aspects corporate change, are looking to sales to a degree, but also broad-based channel support to reinforce and support corporate revenue growth, to buy time for corporate changes and corporate alignments to take effect. Particular note, BMC Software is a vendor that really has focused on turning their sales organization around and taking alliances, including a focus on a partnership with Amazon Web Services. They've really managed to refresh their brand perception on their ties to cloud and their ability to manage cloud, and jumpstart performance for the first time in over a year. Software remains a company that is, at a corporate level, remains a company in transition, but we want to note that HP Software remains a material profit driver with broader HP organization, and we see the focus on not only bringing HP's software assets deeper into the broader HP portfolio, but tying complete solutions more tightly into the Alliance One and other program and other partner programs inside of HP as a critical step to bring long-term ecosystem loyalty, particularly as companies like Oracle are publicly targeting the HP ecosystem to attract net new partners to their own universe.
That's kind of an aggregate challenge to all of these firms is relevance. This is not that their portfolio is not irrelevant, but they're being challenged by a series of cloud systems management vendors, by open source cloud stacks, by various challenges in the security space, both pure plays and vendors such as IBM, who are adding, regularly adding security across their portfolio. So we see these vendors as pure play software vendors have a great position to be able to offer software that is heterogeneous to any particular vendor. But HP Software has the advantage of also being able to connect that to their own hardware brands. So we anticipate that HP will continue to leverage the HP Software brand in deals across its hardware, and that firm begins to evolve its market more completely. We're seeing more messages around HP Software as a standalone offering. We anticipate that the value proposition for HP Software here is a standalone brand. Also, BMC and CA are, again, wrestling with their mix between the mainframe-centric portions of their business and the distributed systems portions of their business, where the distributed systems portions of their business are receiving the highest levels of competition. So Salesforce realignments, portfolio realignments, and challenges from outside parties, putting a lot of pressure around these particular vendors.
And of the three vendors that we're looking at in this segment of our conversation, technologies remains at the lagging edge. It's been refrained across the last couple of earnings calls that sales execution is the pointed trend around around the lagging edge of revenue performance, and we project that to be escalating its focus on the channel in order to supplement and extend its ability to drive revenue growth while it reevaluates its sales strategy. Go to investments to wrap up our trend analysis. We want to take a look at corporate efficiency, and particularly for the end-to-end solutions vendors, or those vendors with more diverse businesses that include software, cloud, and in some cases systems. It's really worth noting that cost management and cost efficiency, particularly around expediting acquisition, integration, and reconciliation, a notable driver of margin growth and margin improvements across calendar year third quarter 2012. I think it's worth noting that this also allows vendors that we look at, we've seen them really use increased profitability as a lever to fuel investments that are designed to defend their install bases from competitive threat. So efficiency, I think the particular metric that I always find most notable is at operating margin. And as you see, like the revenue trends from the earlier portions of our conversation today, operating margins showed a relatively minor decline year to year from 21.3% to 19.2%, showing the success that a number of our vendors have had, a number of the vendors we cover have had in driving increased efficiency, especially as they have continued to grow over headcount and particularly go-to-market focused headcount across the quarter. Our graphs for this conversation, we're looking at calendar year third quarter 2012 revenue growth versus core operating margin for the quarter. And I think it's worth noting that those vendors that were in the lagging quadrant across our revenue-focused conversations are now on the leading quadrant, including Oracle, which is of particular note because despite double-digit declines for the last 3 quarters at least, hardware systems revenues and hardware systems support revenues, the company continues to drive increases in operating margin thanks to extensive efficiencies around go-to-market and around engineering and solutions development. This is particularly notable when you take account that they've added 8,000 personnel to their direct sales organization across the last 6 quarters.
So to look at the per head count trends for aggregate head count, one of the things that we see is how are firms managing that operating expense for employees. So in this chart, we're showing the same curve for the average number of employees. We're getting see that the label for that says number of IBM employees. It should say average number of employees. On that side, though, it's the operating expense per employee. So this is the true average operating expense. So we're not counting the cost of sales here or cost of the services organizations, which includes a lot of headcount, direct headcount costs, but true operating expenses, SG&A and R&D expenses, and how they over time as firms manage that against the increasing headcount. So do see them growing earlier on in 3Q10, 4Q10 to drive business, and then it's been a pretty steady decline trailing over the last 8 quarters as firms begin to see weakness in the marketplace and begin to really target the spend that they're making to drive business. So barring any extraordinary circumstances, we really see this trend, this pressure on the SG&A portion of the software vendors business really continuing over time as firms are looking for the maximum efficiency for their dollars spent in these areas.
I think it's highlighting as well that this is a look at aggregate revenue versus operating income, and a way of measuring the trends we've been talking about to date. Operating income and margin continue to trend upward, even as aggregate revenue continues to trend downward, showing the importance of monetizing and accelerating investments in personal and product to counter prevailing market trends and drive positive revenue growth.
So look at the data on this particular chart. This is the aggregate revenue for all the firms in our benchmark, plus the aggregate operating income for all the firms in our benchmark. So the trend lines are just simple linear trend lines to look at the performance from 4Q09 to 3Q12. Obviously, revenue continues to grow, and we see a slight and slow decline in the operating income delivered by all the firms that are in this benchmark. And that is inclusive of all of the acquisitions of firms that have been brought into the companies that are in our benchmark. So what the indications are for this is that firms are making investments to drive growth into new areas. They're driving either organically through the portfolio or inorganically through acquisition. And the market response, while positive across the covered companies from an income point of view, the cost base is expanding when we look at the aggregate market and having strong downward pressure to keep operating income from going in line with revenue.
And our set of case studies looking at IBM Software, Oracle, and Symantec. I know I touched on this in a number of points earlier when we looked at the broader graph, but I think the key takeaway here is that efficiency and integration, both at product level as well as at a corporate level in terms of ensuring seamless go-to-market, direct and indirect sales, remains the way through which industry leaders as well as industry laggards can either drive forward performance or reinvent themselves in the case of Symantec going forward. I will be mindful of the fact that we're coming up on the top of our conversation. So looking at slide 26, you'll see that this is where we're in year 4Q12, which are in calendar year 4Q12 cycle, which the earnings cycle is currently underway for us here, as well as in our ongoing search for clients. But I think, Stuart, with that, we should open the floor for questions.
Yeah, happy to take any follow-on questions on the content that we presented today.
Great, and we've been leaving some of the questions in that have been coming throughout the presentation. The first question I'm going to answer, given this decline in aggregate operating profits across the firms included in the benchmark, what factors are influencing the decline and what needs to shift to improve industry-wide profits?
Okay, well, I think we can probably jump back to that chart. I think that was a question from one of the last charts that we took a look at. So when we have the aggregate revenue increasing for firms in the software benchmark, and then a slow decline in the aggregate income, operating income, one of the things that we see certainly as a driver for that is that firms have to spend more money to create each revenue dollar. The cost per revenue dollar is going up. One's driving that certainly are new delivery modes. Firms that used to just have to deliver right under a license agreement and then service it with maintenance are now faced with additional challenges. Well, how do you deliver it via cloud? How do you deliver it to mobile devices? How do you support partner-delivered services? Ecosystem and options are ramifying, so selling, pricing, supporting, making that clear to clients around which mode works best for them. just as increasing conversations, then the length of sales are increasing as well. I do see that erosion continuing, but there's, obviously high value areas we see driving business and high value business. We have BI and analytics. We have this move to facilitating the mobile worker. These are high value areas that we see transforming industries like retail, for example, where mobile point of sale, e-commerce, and BI are certainly key investment areas that are tied to back-end realignments of supply chain, data management, workforce management, merchandising, shipping, things like that.
A couple more come in. I'm going to try to get through one, possibly two, before the end of the event. The next that came in is, we've seen several big trends converging on software vendors: cloud, big data, and big analytics, mobility, consumerization, and social enterprise. What do you see among end users that signals changes in their spending behavior given these trends?
Question. So let's tie that back to the vendors. When we look at the leading vendors for this quarter, we see that the vendors who are tied to those trends at a kind of brand level are doing extremely well. For example, VMware their performance is very strong, driven through both organic and inorganic growth. The key to firms like SP, who are making advances, through large additions to get into the cloud space, but also very successfully monetizing their Sybase acquisition in mobility, are keys to that expansion. So, connecting the portfolio of these trends also requires a dimension of being able to connect the offering and the value proposition back to the business need. Right? So, why do people need mobility? So, in retail, people need mobility so that they can, get people out from behind the sales terminal and selling on the floor, or enabling end customers to buy mobily cell phone while they're, out and about. These are landmark changes, sea changes in the way that the business models of the clients are being executed. So being able to tie that back, the products back to those, how the trends are impacting the end customer are key.
One question. What's the impact, as long as you answer it quickly, what impact for software companies, since you imply they will need to support multiple delivery options, traditional cloud, hybrid, or partner delivered?
Yeah, so obviously there's a capabilities impact, right? Firms that used to have, deliver the software to a partner who then did the implementation, and then the vendor did the back-end product support, certainly need to be able to build out more robust service and support capabilities to be able to support cloud-based deployments, which have more end-user technical support requirements. So there's a different type of person that's being spoken to. The requirements there are different. The fact that we're now getting kind of meshed up and delivered into mobile interfaces is oftentimes an architectural problem. But one piece is that we see is being able to answer the question for the client: why did I consume the product one way over another way, and what does that mean for me from a business impact point of view? And it ties back to, how are you going to help the client drive business, right? So there are increased expenses in terms of support, but the ability of the software vendor to leverage that support as a value add rather than just as technical overhead for a product is really key, particularly since we see these disruptive trends moving through the marketplace. So how do you fix? Then you do systems optimization, and then we're beginning to see a few vendors really venture up into what is kind of new territory. How do you use support and services to drive innovation, which we think is a great value prop cement for the promises made by the product suites themselves.
And in the case of some vendors that have the ability to do so, they're saying if you can't meet hype, beat the hype, by focusing on delivering what, in the words of Oracle, is a seamless customer experience, showing no impact in performance or user experience to a customer, regardless of on or off-premise deployment. So I think the marketing skirmishes are only going to escalate in the coming quarters.
We're out of time, so I want to thank everyone for attending. Before you all sign off, there's a couple quick things I want to remind you of. Please engage with us through social media. We will be on YouTube as well as slides, which I just sent out the link. You can also connect with us on Twitter. Once you get the slides, you can follow Stuart, Elizabeth, and TBR for more insights. One additional thing that we'd like to ask for your help with is running a short survey on the presentation and the presenters at the end of the event. If you could take some time and let us know how we're doing, we'd really appreciate your feedback. We're going to leave the chat function open for another few minutes to see if any last-minute questions or requests to set up additional conversations. And if we don't hear from you, we look forward to connecting with you guys all again next quarter. Have a great day.